S&P 500 is trading at all-time highs. It couldn't be better for the bulls, but underneath the surface, there's a couple things brewing. In this video, I'm going to go through what you need to know and how to trade it. So let's dive into it. So I have here the chart of the S&P 500 up 28 points. This market is Teflon, like it throws a government lockdown, all these different headlines coming out, and the market just brushes off a quick 50 S&P point sell off and just punches to fresh new highs. Obviously, it feels incredibly bullish, but what are the things that we need to know? Well, first of all, this upper range around 6,800 is the completion of a number of measured moves. It's still from a duration and magnitude to the 100th percentile of market moves this decade without a 5% correction. It's just been a relentless rise. So the way that I like to describe it is it feels very 8th or 9th inning of this bull advance. That doesn't mean we have to have a horrific market crash or something really scary on the other side, but almost every rally ends with an exhale of some sort of profit taking or correction, and we're long overdue for it. So what are the things that we're seeing here that are the kind of flags that you need to watch that are going to give you a clue as to what is in store? Well, first of all, I want to highlight that one of the sectors that I continue to believe is critical is watching financials. And so I'm going to use the XLF financial ETF as our way of looking at this. Now, the financial index is pretty much beta 1. It has more or less moved with the S&P 500 quite accurately throughout the entire crash of Liberation Day and the entire subsequent rally. What we have seen is the financials lose almost all momentum. You can use pretty much any technical indicator that is measuring momentum, and you will see that this is, even though trading along its highs, lost all upside movement. Now, we did just test the 50-day. It is reversing higher. In no way have we seen a technical breakdown, but financials are no longer participating. This is supported by the fact that when we look at the market breadth, I was sharing before in previous videos, when just simply looking at how many of the 500 stocks that make up the S&P 500, how many of them are participating or contributing to this rally. Now, if you go back to May and June, we had 80% of stocks in the S&P 500 impulsing higher and driving that trend. A very nice, healthy, broad rally. Now, since this market's been climbing higher, making higher highs, yet the breadth has been deteriorating to the point that we have numerous times went to 50%, or even earlier last week, we were below 50% of stocks in there. So we have a trend where underneath the hood, we see deterioration in this. Now, it's not just of this broad basket of 500 stocks. But we can even see that when simply going through the actual Mag 7s. So let me just start off in order. Like, take a look at Apple. Apple has been a big contributor to this rally in the last month, but it is now approached its previous high, a big resistance, while having completed a measured move, and definitely over the last week has stopped contributing to pushing this market higher. We take a look at Amazon. It has actually been correcting in the last 3 weeks and is actually spending legitimate time below the 50-day moving average during this window. Then let's take a look at the M's. Like, let's have a peek here at, let's say, Meta as well. Double topped along the highs, has been correcting for a week and a half, trading below its 50-day moving average. Take Microsoft. Microsoft has been correcting for almost a month and a half, but even though it's been more or less above its 50-day moving average, notice that it has taken almost no accumulation and hasn't been driving higher. So where we have seen all of that momentum has been Google, but yet even Google in the last week has been correcting. Another major leader in the last few weeks was Tesla. And Tesla had this huge impulse over the last 3, 4 weeks. And look at this bearish engulfing candle and distribution that has more or less happened after it retested its previous highs. And so you can go stock after stock. There's only one of the major stocks that actually looks like it's cleanly contributing, and that's NVIDIA. And so when we look at NVIDIA, it consolidated for a month, it's broken 52-week highs and not given it back. Now that is the big boy. It's a 4 trillion mega cap. It's broken to higher highs and is clearly got momentum. But think about that. We are literally, when going through Mag 7s, it pretty much is now being driven by just a handful of these on the short term. That continues to demonstrate the breadth issue that is happening in this market. Now, that could be a double-sided coin, or it could be the flip of a thing where suddenly if all of them did contribute, maybe that will become a bull catalyst. But I would argue that that would be what we would need to see to make the argument that we're going to 7,000 or 7,300. We would need to see all those Mag 7s. They're just so important from a market cap weighting into the S&P for them to be able to be generals and leaders and help the rest of the stock market drive those higher levels. If we continue to see this trend where the Mag 7s are huge laggards and not contributing, then it's going to be really hard for the S&P 500 to make any progress. Another thing that's really interesting as an observation is that we had a huge bump in the healthcare space. Obviously, that was driven by that Trump deal with Pfizer and caused the XLV to turn. But this is a defensive part of the S&P 500. This is where money is rotating in moving from cyclicals to defensive. Typically, that is not a good thing for the broader markets. And so, with the financials not contributing and things like the healthcares contributing, this is all showing sector dynamics that I don't think are very positive right now for the broader markets. So what it really comes down to is, when will the stock market care? Well, clearly the government shutdown is not a factor. Jobs numbers are not coming out because of the government shutdown. So we really don't have an immediate catalyst present. But it's always that saying, it's what you don't know, that always turns the markets. So we're just going to have to watch closely day by day to see when inevitably a catalyst pivots the sentiment and actually causes a profit-taking cycle to ensue. Generally, I would summarize this market as being overstretched on the upside, very poor in asymmetry, very late innings in this advance. But if I was to give you a glass half full, if all we got was a quick 5, 6, 7% market correction, it was generally well defended, everything held in, there's always a chance that that could be used as a base still to have a very strong year-end rally. So by no means am I trying to put nails in the coffin like there's some big crash yet, but this is how a lot of the markets behave a lot of times, right along tops. And so we just need to be a little bit careful. This is a great time to be overlaying hedges. In general, we have a very low implied volatility. The vol skew is steep. So therefore, putting on things like put debit spread hedges is relatively cheap in terms of the payoff profile to the capital outlay. Very good strategy of staying invested while giving yourself a buffer to help you with downside volatility if some kind of surprise kicked in here. Now, I wanted to highlight a few other things in the macro markets. Number one, I wanted to just touch on Bitcoin and crypto in general. What we had has been a 2-3 month consolidation in Bitcoin. It's been a very quiet. It's been inactive. Gold has been taking all the attention. It's almost been like the forgotten real asset per se. And what we saw in the last week was Bitcoin and in general crypto has woken up. Now, what is the positives? Well, what were all of the previous highs back over here acted as support. In general, the entire pullback was contained to the Fibonacci zones, and we have now broken out of that consolidation. This now that has had such a 2-3 month period of consolidation has unwound the entire overbought state, which means that if the bulls here can make this stick, this could be the early innings of a new breakout. So watch out to see whether or not this turns into a bull trend. If it does, the first targets are up in the 130 to $135,000 range on the upside, and that would be, I think, a very realistic target if we could see a fresh high. Like obviously, we're trading right into some key overhead resistance. It's going to at least initially be the first real test of this trend to see if it's really got some meat on the bone. Finally, I wanted to just give a little quick update on gold. This has been one of the most relentless bull advances that we have seen. It just doesn't want to quit. Even yesterday's quick little dip got quickly bought on dip, and the traders ripped it right back on the upside. The measured moves on this rally remain towards 4,000 to 4,050 on the upside. So there is no reason at this moment to feel that it needs to stop at 3,900. So there is still room to go, but I do view that this is also a very late inning advance. It's not that there's a nasty correction or that the big picture bull market in gold is over. It's not. But whenever gold has in the past finished a big bull impulse, it goes into this kind of holding pattern, usually sometimes for many months, that it consolidates. So as soon as we reach some upper ceiling, expecting a prolonged period of gold just pausing and consolidating is entirely plausible. And so to me, I would not be chasing gold here on the upside with new positioning unless you're willing to express it with some sort of convexity. Again, bull call spreads are a fantastic way, especially since the right tail skew on gold options is actually steep to the upside, allowing you to actually build good risk reward payoffs, and allows you to not take the risk of getting caught in what could end up being even several $100s of gold volatility that could swing against you just in typical price action that you would see. So right now, definitely there's room for this to go a little bit higher. But if you wanted to participate, you want to find some new convex way of putting on that trade. So that's your update. If you want to follow these kind of updates on a regular basis, then in the description below is a link where you can follow me on a daily basis. Thanks, everyone.